Hello and welcome to Switzer Investing. I'm Peter Switzer. Thanks for joining me. On tonight's show, I've got Berman Invest Julia Lee and Adam Dorr of Shaw and Partners to look at some laggard stocks that many investors have been preying on for a turnaround. They include Appen, A2Milk, Mesoblast, Lease, PushPay, Splitit and Nuix, and more. And then Paul Rickard gives us 3 reliable income stocks for the cautious non-thrill seekers out there. That's the show ahead, so let's kick off with Julia Lee of Berman Invest. Thanks for joining us, Julia.
Great to be here, Pete.
Now, I've thrown a few, some people might call them nasty, annoying stocks that haven't really delivered on their one-time promise. Let's kick off with them straight away with, this is an interesting one. I don't think I've ever talked to you about this. Pure Foods Tasmania, PFT. And I was just thinking to myself, that company couldn't be doing well with Tasmania being closed down, but maybe I'm wrong. What's your view on this company?
Well, the food part's going well. I guess when I think of Pure Foods Tasmania, I get mixed up with Tasmania Pure Foods, which of course was dragged through the mud a bit with its Bellamy's relationship and Jan Cameron. But I think having a look at Pure Foods Tasmania and purely at the sales side, sales have been pretty impressive during COVID. I mean, if you have a look at some of the things that have really helped sales, they have a pate product. They have one where they package it together with the cheese as well. That's been selling quite well. I think sales are up 19% there. They also do smoked fish. So when you're looking at smoked salmon or smoked trout, they sell that, and that's been growing very strongly. That's been a key driver of the sales growth that they've seen. And recently they made an acquisition of an almond creamery business. So I'm looking at, I guess, the non-meat food area or the alternative meat food area. And that's been doing quite well as well. So look, I have to say this one looks pretty interesting here. I'd just be looking at it as relatively high risk and have a look to see whether some of those trends are reversed, because of course, now that we're stuck at home, we're eating a lot more pate at home and smoked products at home, and entertaining more at home as well. But given that lockdowns are coming to an end, just watching carefully to see whether sales are impacted. But I suspect all of those areas are probably growth areas, especially having a look at the fish side of things and also the almond side of things as well.
Yeah, and I also thought, Julia, maybe the lack of tourists as well, because when you go to Tasmania, you tend to load up on the produce of the country. You buy their wines, you buy their foods and things like that. So there's probably been a bit of a marketing problem for them, in the sense that the tourists haven't been flocking there like they often do when the place is open.
Yeah, I mean, they distribute most of their products through large distributors, so they are available at Coles and the big supermarkets as well. So I guess it is about winning those big contracts. But you're right. I think looking at the trends into Tasmania might help in terms of brand awareness, and just having a look at, I guess, increasing the type of market that it has for its products. I have to admit, Pete, I think I was 18 or 19 when I first tasted pate, and I just couldn't get my head around it for a number of years. And I guess if you're looking at the Asian market, it's all about that perception as well and trying to break into it. But for the moment, it's all about those supermarket sales and, that little bit of innovation, packaging the pate together with the cheddar cheese has been a good one, which has helped to increase sales. And look, they've done very well. In fact, just having a look at their last results, and sales were a record, up by 137%.
And knowing you the way I do, of course, when you were young, you wouldn't have been a wine drinker, but once you start eating wine, it's cheese and then pate.
Olives. they all taste great now.
Yeah, okay. Let's get another one. I think this one is a company you and I have discussed in the past, had a fantastic run for a while, and so I'm sure some people are holding it. PushPay, and you always made the point that the big fish have been won. Now they have to sort of get the smaller fish, the smaller congregations, the smaller churches, and things like that. What do you think this company's doing now?
Yeah, I mean, this isn't. I like the company. The unusual thing is that during COVID-19 and the lockdowns, it looks like their competitors were growing at a much faster rate than PushPay was. But look, it does look like growth is back on the agenda. They're looking to capture, 25% of the US Catholic Church, and recently they made an acquisition into the video streaming area, which of course makes lots of sense given that so many of us are either in lockdown and unable to go to church, and then an increased demand for going to church via the internet or via streaming. So I think that acquisition makes a lot of sense. Given that things are returning back to normal, I think the key here is to watch the sales growth to make sure that, perhaps them getting a little bit behind compared to their competitors was just a COVID-19 impact. And given that lockdowns are really coming out now, that we start to see that growth coming through. But they are still seeing some good growth rates coming through. Just watching to see whether some of their competitors are doing better and whether there is a competitive risk there. But look, I'd be happy to put a little bit of money in this one, but keeping a close eye on it.
Lease.
Yes. I mean, Lease has been beaten down so far. I actually like the company here. I mean, one of the things that the market didn't like is its return on equity measure, or the return it gets on its capital, was pushed out for a year. So it's aiming to get 8 to 11%, but it doesn't think that it's going to hit that until 2024. And to give you an idea where it's at the moment, in 2021, I think it was something like 5.7%. So it's got a fair way to go in terms of trying to get those better returns. But on the flip side, things are looking up in the property space. At the center of its strategy is probably those gateway communities, and certainly things are starting to pick up in those capital cities and business centers, which I think is a positive for Lease. And of course, having a look at some of its office structures as well, there's probably a bit more time needed before there's stabilization in that area, given that we don't know how the office environment is going to settle back and whether there will be a decreased need for leasing in that space. But at these type of prices, I'd have to say I'd be pretty happy buying it and stashing it in a drawer for a couple of years. And really, if they are able to execute on getting up to that return on equity of 8 to 11% by 2024, you're looking at an increase from 5.7% up to potentially 11%, which will be a key driver of the share price.
Okay. Now, two one-time darlings, not so much darlings anymore, Appen. Are we seeing any positive signs for Appen?
Yeah, I mean, recently we have seen the shares coming back, but that's been the whole tech space. So if you have a look at the tech space, it was beaten down as interest rates were rising and the bond yields longer term were rising. And then as that has eased back, we've seen the tech space coming back a bit. I think the bigger question for Appen is how is its longer term what its longer term outlook is like. And if you have a look at Appen at the moment, I think, the last downgrade that they saw to their EBITDA expectations or earnings expectations, they're now expecting that for 2021 that they'll see earnings between $81 to $88 million. Previously, they'd been forecasting $83 to $90 million. But what that means is it means they really need to shoot the lights out in the second half, because the first half of the year, they only saw earnings of $27.7 million, which means in the second half of the year, they need to make around about double that amount to hit their earnings guidance, or, we're going to see another downgrade. So extremely high expectations for the second half. So extremely high risk, I think, in terms of Appen. The other question mark I have over this company is it is in the area of artificial intelligence, but the bulk of its business is in data annotation, which means when you're looking at AI, it's very difficult to automatically label pictures and data. So a lot of that is manually done through labor, and there are people around the world that do it, and you'll often see the Appen advertisements for people to be able to do that for a workforce. And I guess having a look at that, and there's been a lot of talk that some of the big tech giants are looking at their own, their own artificial intelligence to automatically label data. And in fact, just watching Facebook very closely, which is thought to be one of Appen's major clients. And I guess the thing with Appen is that the top 5 clients make up more than 90% of revenue. So if it loses one of that or sees a decrease in revenue from one of those clients, it does have a big impact. So watching this one carefully, I mean, it is high risk, but the shares have tumbled a lot. The 2 concerns I have is whether it's able to meet guidance, or we're going to see another downgrade coming through. And number 2 is more structurally, are we seeing a shift in that data annotation area from manual labor to more automation?
Okay, finally, A2Milk. If you didn't own A2Milk and you're not in a losing situation, is this the time to buy and just keep your fingers crossed over the next 12 months?
Yeah, I really want to say yes, because I've made so much money from A2Milk in the past. I first bought into A2Milk, I think, at 49.5 cents when it first hit the Australian market. But I don't think I'd be a buyer of A2Milk here. And the reason for that is that the major growth engine for A2Milk was really China. And in China, I think we have seen a fundamental shift where instead of preferring those overseas brands because of safety, because there have been some health scares with Chinese brand baby formula, and we are seeing a push to pushing domestic brands. And look, that seems to be working. So it's a lot harder for international brands to grow in China, especially A2Milk, which does look like it's been losing ground. So look, A2Milk, it's a recovery story here in Australia and New Zealand. But the other thing I suspect is, when you're going into lockdown, not only do you stockpile toilet paper, but if you have a baby, you probably stockpile a couple of tins of baby formula as well. So just looking to see whether that recovery is going to be a little bit slow. And look, I probably wouldn't be buying A2Milk here. I think there are better opportunities in terms of the market, and mainly due to that fundamental shift in China away from international brands and that refocus in on selling domestic brands.
Okay. Well, Julia, as always, thanks for your analysis. See you next week.
Thanks, Pete.
Well, Adam Dawes of Shaw and Partners joins us now. Thanks, Adam.
Yes. Good afternoon, Peter. What a great day today.
Yeah, well, the market was up. Didn't instantly go up. I thought it'd do a lot better given the positivity on Wall Street on Friday. But do you often find that our market is a little bit timid until they see what the Yanks do on Monday night?
Yeah, and even watching the US futures as well, we sort of we hold back a little bit for some of that international buying till around about 2:30 in the afternoon, where we can see or get a real clear indication on how the US futures are going, and then we sort of jump in. So yeah, absolutely, we're very timid, but certainly the gold stocks did well today. Some of the travel stocks did well. And it was a good day, a good start to the week.
Okay, I've asked you to look at some stocks that a lot of people have fallen into over the years, and I think the classic one is Mesoblast.
Yeah.
And unfortunately, some people bought at the highs, but some people bought around the $3.20 mark when it was falling, and they've been shocked that it's kept on falling. So I thought it'd be interesting to see what's your view on some of these companies. Let's start with Mesoblast. What do you think's going on there?
Yeah, look, this is an interesting one, and for all the viewers playing at home, this is one that's too volatile for me. So I will be very much saying that I sort of sit back and watch this one with interest, but I don't play in it because it is a very, very volatile stock. But certainly, they've got a lot of cash in the bank. As of June 30, they've got they had around 136 million in the bank. So that's certainly, you would think, a lot. But going through the comments and looking at this stock, and I'm always worried about a biotech, you obviously need to keep up what's going on their cash side of things. But look, they've also said in that $136 million isn't going to last them very long, so that they're going to have to then potentially raise some more money. And I think that's what the market's waiting for, is that next raise before they potentially look at it. The stock's obviously been very volatile going backwards and forwards, but now has started to move sideways and just sort of trade in sort of a shorter range. They do have their AGM on the 30th of November. So anybody who wants to have a listen should definitely listen to this. but also any shareholders. I'm always saying this around this time of the year, every year. Make sure that if you are a shareholder, you vote. Make sure you go in there, you look at the remuneration reports from the directors, you look at that, how the stock's performed, and you make sure you vote, because your vote actually counts and can make a difference. And I think no matter if you hold one share or you hold 10% of the company, it's very, very important that you vote. So this one for me, 136 mil, they're going to need to do another raise. The technology is there, but the FDA didn't get approved. And the problem is with biotechs is that it's a binary outcome. It either happens, yes, it meets endpoint and the stock moves higher. No, it doesn't, and the stock goes lower. FDA came out and said, no, the stock's fallen. It's now sideways motion. Let's wait until the 30th of November to get a bit of a clearer indication on where the company's going. And that's probably my catalyst to potentially look at investing more into this one.
Yeah. I also think the company could do a lot more to communicate to the market. Like, for example, the market would like to know, when is the next FDA test? You know, and by the way, I feel sorry for them in many ways, because I think the last FDA test, 9 out of 10
in the prelim
said yes, it should be approved.
Correct.
The one dissenter influenced FDA. So you can see why a lot of people piled into it when the price was falling. But still, you make the point, it's a speculating stock, and therefore you're running a risk. What about Nuix? Nuix is a company that looked fantastic. Management got in a lot of trouble. Share price falls. I do suspect one day it'll bounce back, but it's going to have to sort of prove itself to the market, isn't it?
Very much so. And really, the confidence is not there in Nuix at the moment, especially because this business is an investigative analytics business for intelligence software, basically pulling out or finding truth in the digital world is their comments. And obviously, the truth is that they had some problems at a director level, they had some problems at a company level, and then that's all been washed through. Now, the stock did rally about a week and a half ago, and we're all sort of scratching our head on no news why it rallied. I still don't know why it rallied, but then it's now started to come back down to sort of those levels where it comes from. Look, I'd be really cautious on this one as well. There's a lot more water to go under the bridge on this one. I'd like to see a little bit more understanding. AGM, again, is going to be a fantastic one. And in fact, I might log in and have a bit of a listen, because, again, shareholders are going to get those rotten tomatoes and they get ready to throw them, because there's going to be some hard questions be answered. So they're lucky that it's all online, and and they can probably mute some of those people that they don't want to listen to. But look, certainly that one, I'd be cautious going forward. It needs to get some more confidence in the market before. And look, even if it gets to, say, $3 to $5, I miss out on that initial rally, I'm comfortable then to get in, because I know that some of these problems have been worked through. So yeah, I'll be cautious on that one. AGM, again, will be another one for me to have a look at what's going on with this company.
Okay, now, this is an interesting one, A2Milk Diagnostics, AT1. Now, I know a lot of people got into this one because there was a press release out that none other than Bill Gates and Lang Walker were significant shareholders in A2Milk Diagnostics.
Yes.
And it went up then, and then it went down.
And still going lower.
Yeah. And is there any sign, look, is there any sign that there's any positive news for this company?
So, yes and no. Rapid antigen testing sales fundamentally have done very, very well. Okay, so they did get basically an agreement from Access Bio, the right to exceed or right to order 20 million COVID-19 rapid antigen testings. And that gave them about $1.7 million of US money that came in the door. So that I think was a real positive. Their HIV business obviously does quite well, and they're looking to do some more HIV testing kits. Again, that has done well. Cash in the bank is around about 2.2 million. Sorry, from the quarter, but overall they've got about 15 million in the bank. So I don't suspect they need to raise anything anytime soon. But, you know, it was all about COVID, and potentially COVID. I know you're in Melbourne there, which is still getting over 1,000 cases, but potentially COVID it's not finished, but that trade has finished. I feel the market's moved on, and you need to be quick in these things. I just think that the rapid antigen testing, there's so many of these tests now starting to come out. As you know, Pfizer's looking at a pill, Merck's got all of these things, so I'd be cautious on this one. I don't think you need to be there.
Yeah, part of the reason why I asked the question was because that magic pill that Pfizer was talking about on the weekend has some link to HIV, and these guys really were in the HIV space, and they kind of pivoted to try and help out with COVID. And I thought maybe there could be something happening going on, but yeah, it's once again, all three are high-risk stocks, and they're not really showing you enough to jump in yet.
And their time in the sun has already happened. So market's very fickle. It moves on very quickly. And if, like you said, people have fallen into this stock or they've heard something and then they haven't sold, or they're not fitting with their trading rules, your trading rules, if it's down 15, 20%, get out. But then they start to get an emotional attachment to it. Those kinds of things, you need to be really careful about that, because then you can be holding a portfolio of dogs, which were all good one day, but not now. So, we need to be careful. And the next business we're going to talk about is probably potentially one of those ones that people are emotionally charged about, or even the sector they're emotionally charged about.
Okay,
Segue to you.
Let's go to Splitit now. Splitit, such a great name. It really hasn't delivered on its promise, has it?
No, it hasn't. And I was reading some articles before today, trying to get my head around the business again. My first problem is with this, I guess, the sector. If you take a step back, the sector, it is a crowded sector now. And the problem is with it, when you get a crowded sector, yes, you've got your leaders, Afterpay, which is a square stock now. So, be honest, that's leaving. Then you got Zip, and then you've got just this, long tail of companies that are trying to get themselves going forward. And we've got a company that we're listing in a couple of weeks, Before Pay. Again, it's a buy now, pay later business. And I think this sector is looking very, very full at the moment. So Splitit has said that I think they lost their CEO, and they're sort of in an interim CEO at the moment. But they basically said that they've been hamstrung by the failure to articulate the differences that this company has compared to others. So, you sort of get put into this bucket and then you move on. I think the technology is absolutely fantastic for Splitit. Certainly, they've done very, very well in the technology, but the job of getting that message out to investors or into the wider audience has been very, very tough for them. So the total transactional value was up 31% on the year to 93 million, and with merchant numbers growing about 85% to 1,200. That's pretty low compared to some of the other ones like Zip, who's putting on, 1,000 customers a day kind of thing. These guys are sort of still slowing down. They are talking about a NASDAQ listing. Potentially that might get a little bit of excitement about that. But look, they're looking, and they're saying they're looking for bigger merchants. They've done a deal with Google in, I think it was in one of their platforms, they've done a deal with Google. But really, at the end of the day, I'm a little bit cautious. The sector's way too full. There's too many players in there. Yes, there might be some consolidation. Yes. But all of them are pretty strapped for cash at the moment because it's a growth story. And this market is potentially looking less like the growth story, more like the value story coming into closer to the year end.
It's funny you should say that, they really need to tell their story better. Well, no one's ever contacted me. The CEO's never got on the show to explain to the investors out there what the potential is for the company.
There you go.
That's the job of the person who leads the business, isn't it? When you think
Absolutely. And it needs to be a simple story, which I think it is.
Yeah.
But and even they've agreed that story is getting lost amongst all the other players, and hence not getting the attention it needs.
In fact, you and I have done more work to help Splitit than the people who've paid to do it. All right, let's go to the final one. This is another interesting company, but this is nothing like the others. This was once regarded as the best of breed in the space, and it had a few curveballs thrown at it. And we've seen some weeks where it's spiked up, but that turnaround hasn't happened yet. A2Milk. Where are you on A2Milk right now?
I'm still a buyer of A2. I bought some last week. A guy from on my desk came to me today and he said, I had a dream that A2Milk was taken over. I said, great. And I think that's what the market's waiting for. I think that we are all hoping that this one is a takeover, and that could be the catalyst for A2Milk to start to re-rate. The other side of it is that when we do start to accept some international passengers coming in, the Dawes potentially might start coming back. And that's the problem with this one. We thought that they had the revenue from Australia and New Zealand, and they didn't need the Chinese and they didn't need the Dawes buyers out there. But all of a sudden, guess what happened? When everything got locked down, we found out that those Dawes were really, really propping up this business. And hence we're from 15 higher, $18 down to sort of $6 where it is today. So look, I think the worst is over on this one. I think it's moving quite nicely. We've had a couple of downgrades. We've had management change. It's ticked all the boxes on the way down. It starts to look pretty good here. But the revenue, the 5-year revenue target does look a little bit shaky at the moment. And they just need to get sort of that press, or I guess those margins to tighten up a bit. But look, my fingers crossed, my toes are crossed, everything else that I could cross, my tires crossed. I want us to see this being a takeover target. One day we're going to wake up and it's going to happen. Yeah. And look, it will be all vindicated. But at the moment, we're only hopeful.
Okay, and you might have a few clients who are cross as well. That hasn't come to fruition. I'm sure I've got some viewers that same boat as well. But absolutely. I do think one day it will turn around. But sometimes you have to be patient. You know, a lot of us want, when we invest, we want returns, you know, within the month or 2 months and maybe 6 months. But really, it might just need a year or two. But then when it comes, it could be a really good return.
Yeah, I agree. I'm long at $10 on this, on myself, PA. I bought some more the other day. I've got clients in it. Yeah, we're holding for better times on this one.
I'm in the money in my super fund. In my other fund, I'm not. And I really wish I'd waited like I did the super fund. But still, I think the future is good for a company like this. Adam Dawes, thanks for joining us. See you in a couple of weeks' time.
Thanks, Peter. Take care.
Well, joining me now is Paul Rickard of the Switzer report, and he wants to talk about income stocks in particular. Paul, what's your research pointed you towards? What stocks look good?
Well, I like stocks that produce income, Peter. I like stocks that also don't have a lot of volatility and so have some annuity type style characteristics. Yeah. I look for some income stocks outside the usual suspects, which of course are the banks and Telstra.
Those top 20 stocks,
yeah, look, something that's a little bit different. The first one, I'll go through 5 ideas for you, or at least a couple. The first one's Amcor. Now, you know, I might not think of Amcor as an income stock, but as, you know, really a major packaging business now, particularly with so much of its business in the United States, it's actually been able to show in the last couple of years since I bought the company there that it actually produces a very reliable quarterly dividend. It's yielding about 4%, Peter. It hasn't been a lot of volatility in earnings. In fact, earnings have been going up. It's forecast EPS growth this year between 7 and 11%. I reckon it's got both growth and income characteristics.
Now, a lot of the experts like Amcor, don't they, Paul?
Yeah, it's been pretty steady this year, trading between about $15 and $17. It's currently in sort of the low 16s. Reported well last week for on expectation for its quarterly profit. And so I think there's a lot of upside with Amcor, particularly as an income side. So that's probably number one.
Okay, before we go, a lot of people hear of Amcor and they know it's in packaging. Was there, the history of Amcor, or are you just purely a money watcher?
No, I've actually been an Amcor shareholder for decades, Peter, because it's been around for a long time. But it's now, 60 or 70% of its earnings are offshore.
Was it always called Amcor?
It was. For the better part of the last decade and a half, it's been called Amcor. I can't think what it was called before that.
I'm thinking like Visy comes from the Pratt family.
Well, it's different sort of packaging, right? Visy is much more in cardboard and stuff.
Because they're in the States as well, aren't they?
They are, but they're not a competitor of Amcor, which is a different sort of packaging. The biggest negative Amcor has probably, Peter, is over sustainable packaging and the pressure from a lot of the companies. And Amcor does a lot in terms of the consumer goods space, so particularly around fresh food. Yeah, but in terms of how you make the packaging more sustainable. Now, Amcor's got targets in terms of making all its packaging sustainable by 2025. It's a lot of companies have that. So that's probably about the negative. But that said, with very strong US economy, very strong local economy, Amcor's going great places.
Yeah, and in the world where delivery of packages are really, really important, you think it's a good industry to be in. Okay, what's your second one?
Well, another one, and I'll probably just do 3. I'll do one at the other extremes. This is been one of my favourites for a long time. It's Medibank. Probably getting
Is he going to bore the pants off with these stocks?
It's probably getting a touch expensive, Peter. But the thing I really like about Medibank is being able to do three things really well. It's being able to grow its customer base.
Yep.
It's being able to grow market share, and it's being able to cut costs all at the same time. Now,
they've even got young people coming to it.
They do, but I think what people forget is that in private health insurance, there are more than 40 insurers. They're the market leader with a share of about 27.3%. And when you're the market leader with that much share in a market with lots and lots of competitors, it's really hard to increase share. And Medibank has actually been able to do it. And in the last 12 months, for the first time since 2013, they actually grew their policyholders in their main Medibank brand. They also own a sort of a youngster brand called AHM. That's a little bit, I won't say it's a discount health insurance brand, Peter.
It's like Jetstar, isn't it?
It's a bit like the Jetstar. That analogy probably takes it a little bit too far, but AHM is for a different sort of market. And what's been happening in Medibank for the first time last year, they actually grew customers in their main brand. So big achievement, and they cut their management expense ratio. And that's the percentage of every dollar in premium income that goes into overhead and staff costs and all those sort of things. That came down. So I think that's a really good stock, yielding about 4%. It's probably pretty fully priced, so it might be a stock you sort of wait for a bit of a market pullback. It's been trading in a very narrow range between about $3.50 and $4, but sorry, between about just below $3 and just over $3. It's now about $3.40.
Around $3.
Yeah, around $3, but very tight range if you look over this historically. Not volatile at all, Peter. So a good stock.
And what is interesting, ladies and gentlemen, if you watch Paul Rickard carefully, and in a sense, I've been forced to do this for over a decade. I've worked with Paul for over a decade. Is that he invariably will go for the best of breed in the industry. So if he did go into buy now pay later, you have gone to Afterpay. You've always been CBA first. You've always been Medibank first. You tend, and it is a very good investment strategy, particularly if markets sell off big time and you want a chance to get at the companies that you haven't got. If you go for best of breed, historically, it's a very good strategy.
And I would not necessarily have said a couple of years ago that Medibank was best of breed. I think NIB might have had
that's
that
true.
title.
That's a good company.
But Medibank's is sort of a scale bigger, about double the size. And of course, NIB is a good company too. It probably got a bit expensive. So I just think Medibank is, it really happened under the previous CEO, Craig Drummond. They've got a new CEO. They've been able to carry through the leadership. And I think they're killing the other brands.
Okay. So far, you've given us two very good stocks. Not exciting. Is the third one going to be a little bit exciting?
No, it's going to be less. Well, I don't think it'd be less exciting than private health insurance. That's Medibank. The third one's going to be the Charter Hall Long WALE REIT.
That's better. That's better.
And it's called Long WALE. That WALE is the WALE, which stands for weighted average lease expiry. And that means that the tenants it contracts with all have sort of 10 plus years.
They're there for a long time.
They're there.
Paying rent.
Typically government or things like logistics companies on the service stations, they're very long-term rents. Could also be things like telco exchanges where you've got Telstra and those sort of people. They rent them, they lease them back on
good rent payers.
On good rent payers. So this is a REIT that's done really well. It's yielding about 6%, just a little bit over 6%. It's about $4.90. They've done a few acquisitions. They've recently announced another acquisition. So that's probably the only downside, but trading below NTA. Look, don't expect.
Explain what NTA is. Some normal people would know what NTA is.
So NTA is net tangible asset value. In other words, that's what happens if the property trust could sell all the assets it had at market value. What would unit holders actually get paid if the trust was wound up? Remember, it is just a trust. It just owns financial assets, effectively. A building, that's a financial asset or a type of financial asset. And so
funds are like that as well.
Funds are like that. So NTA is a really important concept to have in your back of your mind and to look at when you're buying a trust or you're buying a listed investment company or something that just owns assets, other financial assets. Have a look at the NTA. That sort of gives you an idea whether you're paying too much or too little. Now, it doesn't mean that you can't pay more than NTA. Often you might want to do that, but it's just another data point that can be really important.
But you said in this case, the unit price is below NTA.
Yeah, it's below NTA.
You're buying in a possibility with one day that might go above it.
Yeah, and I think that they're running a pretty good business. So that's Charter Hall Long WALE REIT. Main negative around those sort of investments at the moment is they're quite heavily geared. So gearing's gone up to just over 40%. If bond rates, go up, these sort of investments will get hurt. But that doesn't mean they have to refinance straight away. In fact, there's no refinancing due at Charter Hall Longvale REIT for at least a couple of years. But in due course, they're going to have to roll the money off. And sometimes the market just sort of gets
ahead of the curve.
Head of the curve, and we've seen that before. So,
but that can be a buying opportunity.
That could be a buying opportunity. Now if you look at what's happened to bond yields, they've gone up and they've come back again. Yeah. So, on the course of the year, there's not really that much going on. Now, you and I probably have talked about bond yields longer term. We think are going up, but they seem to be, if you look at the last month or so, they've actually come screaming back again.
Yeah.
So,
well, it does get down to that bit. Is the inflation, particularly in the US, transitory or is it locked in? If it's transitory, then bond yields will come off. If it's permanent, they'll go up. And I think at the moment, there's a little bit of favour towards transitory because of some of the numbers we saw over the weekend.
And strangely, the tapering in the US is actually probably a long-term positive, because although it's actually going to mean that the market's going to have to find a home for all the US government budget deficit, it might just mean put a brake on that, right? Because if suddenly, the Feds aren't buying all the bonds and it's got to go to the market, the administration might think a little bit harder about how much it borrows. So it's interesting that since you got that sort of announcement, actually bond yields have come down. When you expect, often the case with the markets, it's buy the rumour, sell the fact. In this case, they sold it up ahead of the tapering announcement. As soon as tapering came, hang on, the bond yields have come down.
Trying to second guess the market can be a very big mistake. Paul, one last question. Tomorrow, NAB does its show and tell. Tell people what the show and tell is.
Yeah, so this is NAB's full-year profit result. We've already had ANZ and Westpac. ANZ was about as expected, but probably the negative on ANZ was that the home loans went backwards, didn't grow. Westpac was a bit of a disaster. No one was expecting Westpac to be as bad as it was. And it was when I say it was a disaster, look, this
wasn't as good as expected.
It was bad on two counts. First of all, their net interest margin deteriorated really badly, which meant basically that they've been sort of chasing market share by sort of trading off price. So a lot of, in the home loan market in particular, they've been writing a lot of fixed rate loans, which are a lower margin than the so-called variable rate loans. And so their margin came down. And they gave out some pretty negative signs in terms of what the margin would be going forward. The other thing, of course, was their costs went up. Now, we know that Westpac is investing a lot in things like financial crime and all those sort of things, but they have also
stopping financial crime.
Sorry, investing to stop
in financial crime.
Sorry, correction. Yes, important correction. Investing to stop financial crime, and that means a lot of extra compliance people and costs. Their business as usual costs went up too, and this is from a group that's allegedly taking its cost base from something like about $13 billion down to $8 billion by the end of 2024. So that was a big no-no. So tomorrow, National Australia Bank, it's the last of the major three to report its full-year profit result. Market, I think, is probably, you and I have been a bit keen on the National Australia Bank. Ross McEwen's now been there 2 or 3 years to sort of start to make his mark. We'll be looking for growth to see whether their mortgage book is up, also whether their business, what impact the COVID's had on their business operations. But apart from that, it was a very clean first half result. We're expecting a clean result tomorrow, not too much NIM pressure. And the market, I guess, goes into the NAB results saying it should be good. The proof will be in the eating, but that's tomorrow morning.
Yeah. And, I'm hoping the outlook says that they're starting to see some inquiries from business loans and things like that, which may be a bit slow now because lockdown's been a problem. But I do believe when we get into 2022, business will get more excited because they might need machines to replace workers because they're a bit short of workers, aren't they?
They might indeed. So that's a big thing for our market. Now, if NAB, is a bit more like the ANZ result, then I think the market can sort of take bank stocks high and put Westpac down to just a one-off, a competition thing. And, but we've seen, the market wants to go higher. It needs, a key part of that is that the banks have got to be part of that. Yeah. Otherwise, it'll be challenging.
Okay, that's Paul Rickard from the Switzer Report. That's your show for tonight. Thanks for joining us. And if you need more information about stocks you want to invest in, have a look at the switzerreport.com.au website. A lot of additional analysis on different companies you'll find there on that particular website. Thanks for joining us. See you on Thursday night.